hanging out online, they can participate and join right on in. But for those that are online, if you would like to join us in person, we have started the event at 6 o'clock to allow just for an extra 30 minutes of networking at the beginning of every social, just like we are doing here tonight. So we have beer and wine and food here in the office. So if you want to come and join us here in the office, in person, live, do be sure to do that at 6 o'clock now, every second Tuesday of the month. And we are going to switch it up a little bit. I will now be doing some announcements at the end just to jump right on into the meat and potatoes of the presentation. So I'm going to go and bring up Josh Andrews. He is the author of Paper Profits. He's an active buyer, seller, and note modifier himself of distressed notes. And today he's going to talk a little bit about his expertise and how it can help you in your investing career as well. So let's go ahead and give Josh a round of applause.
All right, thank you for that. Thank you, everybody, for taking your time out of your day to come down here tonight, and everybody who's watching as well. And I'm excited to add some value to your investing tonight. We've done a lot with Quest. I've had a lot of experience with Quest, a lot of our investors, and I would say that hands down, this is the easiest company to work with, not just from our end, but also from the investor side. So the forms, the fees, all of that stuff, this is a wonderful company to be with for your self-directed. So my name is Josh Andrews, and I live here in Austin. I've been here for about 6, maybe 7 years. And one of the things that when I was leaving here tonight, I'm a little bit of an introverted person just by nature. And I was telling my wife that I'm going to come down here and do this. And she's like, oh, well, that's really nice. You get out of the house and do something, you know? So I think she just kind of wanted me out a little bit. So I told her it'd be an hour, hour and a half with the drive. Not here, not all here, not an hour. So I'm with Paper Profits, like they had mentioned. In 2017, I wrote a book called Paper Profits, and one of the chapters was actually co-authored by Quincy Long from Quest. And the purpose of the book really was to explain to folks what note investing was, my experience with it, and how investors like you and I on the secondary market can benefit from it. And particularly with your IRA, with cash, doing it yourself or doing it with another company. And my thought behind that was really, I wanted to be able to give something to like my parents, who it was difficult to explain what I did. Like, this is in simple layman's terms, it's not that complex. You know, if they read it, they would understand. So we're based here out of Austin. My partner, Jane Wobbs, she's a licensed CPA and kind of keeps me in line with a lot of things. This is our website you can go to anytime if you'd like, paperprofitsfund.com. Our focus right now is investing in performing mortgages, but I have extensive experience with non-performing notes. I actually started in 2012, and my first note was actually a non-performing second lien, which sounds like garbage, I know, but they're very profitable, so that's kind of how I got started a little bit. You can pick up a copy of my book on the website. It's just a form. It's a physical book. We can ship it to you. It's completely free. There's no fluff. It's not selling. We're not trying to push you into anything. It's just educational information. And I believe it's chapter 7 that actually has the chapter with Quincy's information, where it just talks about how to use or take advantage of this type of investment in your self-directed IRA and what to expect and the things like that. So today, what we're going to talk about just briefly is we're going to talk about how I began in note investing, just so you have just a little bit of my background. We're not going to get too deep into it because people like to talk about themselves, and that's not what you came here for. We're going to talk a little bit about the note investing fundamentals. So I'm going to assume, just because I haven't spent time together, that you're starting from the beginning. So I'm going to go over just some of the basics. And then we're going to talk about some of the recent financial issues with the bank collapse, some other issues that I think as investors and with our retirement we need to be aware of and just kind of think through as we're planning. And then we're going to talk a little bit about the main goals that I believe should be goals or considerations for a self-directed, which is retirement account, how to structure that, thinking about the future, planning ahead, and not just going with what is easier, what feels good. We're going to talk about note investing in particular because that's my expertise, why I believe it's a good fit for self-directed IRA investments. And then we're also going to talk about the risks because a lot of folks will talk about what's good, what's great, this is awesome. Everything can go bad, every investment. There's nothing for sure in my experience. And so what can go bad? What are the risks? What does that look like? We're going to compare it to other investments, and then we're also going to just look at some options, what our company does, and then what you can also do as an independent investor as well with your self-directed. So brief history on me. I began investing in 2012, like I had mentioned, with my self-directed IRA, and I had the very first note I purchased was a performing second lien on a property in California. And it was kind of weird. I had a mentor, somebody who I bumped into at the time, just a referral from a friend. And he explained it to me, and I said, that sounds kind of ridiculous. And I was working at a bank at the time, being a loan officer. So I didn't really know what I was doing. I was just selling loans or originating loans to people, refinances, purchases, things like that. And the gentleman had said, well, you should look into actually buying these things. And I didn't understand how that would work because we were originating, we were giving people 3 to 5% rates. And so I'm thinking, how would you ever live off of that, right? Because you just need an enormous sum of money to make any money as a personal investor. So he explained a little bit about discount, buying loans at a discount, a whole number of things which opened my eyes. And then I went on to do a lot of reading and understanding and got very fortunate to have some mentors to help me. So my very first loan, $19,000, and I just wanted to see how it worked. I wanted to see all the fundamentals of it, see the paperwork, do the transaction, and then actually see the money be deposited. So after that, obviously I did a lot more of that because I liked it. I saw the results, liked it, made a lot of mistakes, had a lot of learning experiences, and then actually, as I was becoming more successful with it, got friends and family involved, and then finally fast forward to today where we actually raise money and do that in a private fund. Okay. So just talking about, assuming we haven't talked about note and mortgages a lot in the past, or assuming you don't know much about them. So I use the terms interchangeably, but really they're just two separate pieces of paper. They're two documents. And a note you can think of as just the IOU. So this is typically one document that is not recorded at the county, and it's the IOU. It just spells out the terms of the loan. So it spells out the rate, the payment, when everything is due, et cetera. The mortgage is the security instrument. So it's either the mortgage or the deed. That's recorded against the property at the county level, and that, as the lender or the bank, that's your security. So if the borrower stops paying, that's your way of actually enforcing or maybe doing a foreclosure or something. It gives you legal claim to that property. So kind of fast forwarding a little bit on how banks operate and the recent crisis. So how banks operate is somewhat similar to a mortgage investor, with the exception that we don't have the fractional reserve system. So the fractional reserve system with banks is, they can lend 10 times whatever your deposit is. So for every dollar, they can lend 10 times that. So that's obviously can be extrapolated to where, you can get insolvent really quick if that's handled incorrectly. And we've seen that happen with 3 banks this year, right? For a number of reasons. So the way banks operate is essentially key to the economy. I don't think it's a parasitic type of thing. I think we need that for loans, for businesses to thrive and grow, all of that. It's very important. So they provide liquidity. It's very similar to loan investing or note investing, with the exception that we don't typically originate, we just purchase, right? So we're purchasing on the secondary market, typically at a discount. And I'll explain a little bit about a discount and what that looks like. But the one thing I will say that individual investors like us and banks have in common is we do have a security instrument. So that's one of the things that is very, very nice about note investing is you have a security instrument. You have something to come back to in the event that things don't work out. So this is an old list from another slide. There's actually 3 failed banks this year. And this was kind of a new thing for me, like tracking failed banks. So as this was happening, I was really curious, well, how many failed in 2020? How many in 2009? Like, is this a normal occurrence, or should everyone be spooked about this? And turns out it actually happens quite a bit, but just in waves. So in 2020, we have, 4. So we have 3 this year. We're halfway through the year. And then in 2009, when we had the huge catastrophe, we had a lot. And so obviously everything went in the toilet there. So it does happen. It's not the end of the world, but it is something that we as investors should be prepared for and diversified for into different things. I went to go open a commercial banking account, I won't say where, a month ago, and they wanted a minimum deposit of $100,000 just sitting there at all times. And I thought, well, that's not really great for me because I can't use that, right? It's not earning anything but marginal interest, and they're getting all the benefit. I mean, I'm getting an account, but that's about it. So a lot of the way this is set up is not beneficial to us, but we can leverage it. We can just be cautious with this type of thing. So I think some of the lessons to learn from this, as things, we have a lot of uncertainty in the economy, in a possible recession, all of these things, is really to keep an eye on how are we planning things out for the future, having things diversified enough with either hard assets or something that we understand. And I think that's one of the keys, is understanding what you're investing in, not just because it seems to be hot at the moment, but understanding what you're investing in and having it spread out. So not having it all in one thing. And I think some of the bank failures and otherwise, to me, show that having all your money in 1 or 2 banks, just in cash. I mean, I have relatives that have things like that, and it's a little bit scary because it's all of their savings, right? You couple that with inflation that's eating away kind of silently at your money, and it's a losing scenario, right? Not to say that you don't need 6, 12 months reserves, all of that stuff. I'm talking about money that you're actually saving for retirement, money that you're planning on investing, things like that. So the idea, the takeaway, is to have it in something that's earning money, that's keeping you ahead of inflation, but also keeping you out of something like this, should it happen, that we have no control over, and that we shouldn't really worry about. It's not something that, doom and gloom, like the whole world's going to burn down. This is just something to be cognizant about and understand that, the money needs to be deployed in a safe, dependable manner. A guy I follow pretty closely is Ray Dalio. He's one of the largest hedge fund, I think he's recently retired, in the world. So he started a company called Bridgewater, and I think he's one of the richest people on the planet, pretty close. So anyway, he's very insightful, and he has several different books. And one of the books I would recommend, I'll tell you in advance, it's a lot of pretty heavy reading, so it's not like exciting. But if you're interested in the topic, Big Debt Crises, and he talks about the dynamics over time, over the last 200 years, of different civilizations where they've gotten into really, really bad debt, like we are now, almost on a global scale, and then how that's corrected and kind of flushed through the system. So to me, what that does is it kind of gives me some insight on the macro level where things could be headed longer term, and how to position ourselves as investors. What should I be kind of trending towards to protect my wealth and protect, my earnings, my future. So I would recommend this book for sure. And then talking about self-directed IRAs specifically, I've thought a lot about this, and I think some of the main goals, at least for me, would be, to contribute as much as possible, right? That's kind of depending on where we're coming from. That might be part of the hurdle, is to get as much money in there as possible on a yearly basis, grow the account safely, make sure that it's going to stay ahead of inflation, it's going to grow, but we're also not gambling with it. And then, of course, like I mentioned, diversify the holdings to be prepared for unexpected events. Now, that's hard because we're also looking to invest in, number one, things that we know, but also things that are not necessarily correlated. So you might have real estate, and then you might have stocks, or something totally uncorrelated. So if one tanks, the other one's doing well, or at least holding, treading water. You're not like having everything sink if the economy goes poorly in one direction. And then another factor, as you're planning your IRA and what should I be investing or reinvesting in, might be how much more time do you have before you need to access it? So that's a key consideration, because if you have a lot of time left, 15, 20 years, you have a lot of room to make mistakes, you have a lot of and recover, you have a lot of room to do things and I wouldn't say experiment, but essentially take a little bit more liberties to grow it. If you have the next 3 years or 4 years that you need to use that to retire on, you have a lot less time to recover if mistakes are made. You have a lot less time to take chances on things. And so that should be part of your consideration when you're thinking about a new investment, thinking about, okay, well, maybe I have some new funds in my IRA, where should that go? That should be part of your overall plan, as far as just like how you would structure your life, right? Like, what do I want this to look like down the road? And then ultimately, the idea is financial freedom at some point, is being able to live off of the interest from your holdings or from your IRA down the road. So where you're not necessarily eating into your principal, but if you're earning interest, you're earning any kind of income where that is able to pay you for your lifestyle, right? And you're not drawing down and seeing the money draw down. That's the goal ultimately. If you have enough time, if you have enough resources, what you should design out is to make that happen. And then focus on your number, the financial freedom number. That's different for everyone. Financial freedom for some people is $3,000, $4,000 a month. Other people, they might need $30,000. So there's not a wrong number. It's more or less when you get to where you want to retire, or even semi-retired. Like, I can't really think of where I'd want to sit on a couch and fully retire, because I enjoy doing things. But you might want to say, okay, I don't want to have a 9-to-5 job anymore. I want to retire and then do something on the side. So I think those are really important considerations when you're looking at today's economy, things that are going on, the uncertainty that's going on, and just being aware of it, but not being fearful of it. Being aware of it and being able to plan, right? Thinking it through, okay, take a step back. How does this apply to me? A large portion of this I can't control, so I'm not going to freak out about it. It's just, how do I design my life, my investing, to protect my family and the money that I've worked hard to protect? And so we'll talk a little bit about notes. So notes fit really well into this. I don't think they're the only piece. Notes fit very well because in a self-directed IRA, and some of the reasons for that is they produce cash flow from day one. So you have, and we're talking specifically about performing loans. So performing loans are loans that are paying as agreed, just like you might have a mortgage on your home. You purchase those on the secondary market, and I'll explain that process a little bit. And so from the day you close, that month you're receiving a check. You're receiving a payment, mortgage payment from that borrower. And what that allows you to do, typically you have terms of anywhere from 5 years to 30 years left on this loan, and you may not hold it for that long, but the advantage of that is it's very predictable. So you have an ability to say, okay, maybe this is a boring payment, but I'm earning the yield that I need to. My IRA is, I've got 10 years left, whatever that is. I can chart out, if I just sit there, how much this is going to earn me and when I can reinvest that. So it's very, very easy for people that like, engineer types, that like spreadsheets or whatever. You could chart out however you want to figure out where you're going to end up. And then you have safe, predictable returns. And like I had mentioned, the key to that is having something secured by property. And there's a lot of due diligence that goes into that. When you're purchasing the loan, that's a whole other talking point that I could get into. But there's due diligence where you have, you're considering the value of the property, you're making sure there's sufficient equity, a whole bunch of factors that go into that. But once you're done, all the heavy lifting is pretty much done. That's 80% of the heavy lifting is upfront prior to purchase. And then you basically put it with a servicer and you're done with it. Another item that makes this very attractive for self-directed IRAs is you have fairly attractive yields that are much better than annuities, bonds, things like that. Now, it's going to depend a little bit on the type of investor you are. So if you're a very, very active investor, you need to hit, high teens, you need to hit in the 20s annually to make things work. This is probably not the fit for you. However, it is still very, very attractive and stays far ahead of inflation. And you can also compound it. And there's a number of ways to do that. You're involved in real estate, so you have that security part, but you don't have any of the downside. For if you have rental properties, you're not getting called. There's no AC unit going out. There's nothing like that. There's really no overhead whatsoever. It's a completely passive investment, and completely is probably not the right word. I don't think any investment's totally passive. I mean, even ones that seem, I still have to answer an email or I still have to do something now and then. So it's not totally passive, but largely passive, meaning you're going to need to look at your portfolio every now and then or send an email or do something like that. They're easily liquid. So let's say you bought one and 2 years later, you've been receiving payments, your IRA's been receiving payments, and you need to sell it. So there's a huge secondary market. So you've got the first market is like banks and credit unions that actually originate all of these loans. And then you have a secondary market where a lot of these loans are sold down to at some point. And those are investors like us. So you and I and hedge funds and other folks, that's the secondary market. So it's billions of dollars of buyers and sellers. And you can buy and sell your loan on that. It's very easy. I've sold several loans just over the weekend through an email. And it's actually pretty surprising. So what I'm getting at is you have an easy way to get in and out. Relatively easy compared to, let's say, a real estate transaction where you actually have to find a buyer and then usually they have to find financing. This is all cash. So someone who's going to buy that, they have the cash. There's no financing involved. There's no, escrow closing, really nothing. And with this as well, it's easy to take care of or take advantage of compound interest. So compound interest with an IRA, I think, is one of the more powerful things. And with notes, there's a couple ways to do it. So you can, let's say you have, you're getting that boring stream of income, and you can calculate out how long in the future will I have enough money from this to go ahead and buy another, right? So some folks, if they have a lot of loans that they've purchased, just a private investor, you could do that every few months. I know several people who are doing that. Just they save up the cash they get from the loan payments, and then every few months they go out and buy another, right? So they're snowballing this. And then there's other opportunities with other companies and with ours as well, with what we do, is we actually let investors compound sooner. So they don't have to have a set amount of money. It's just once they're invested, every quarter, so 4 times a year, you can just automatically reinvest. So even if you only have $900 in there, you can automatically reinvest, costs you nothing, and you're taking advantage of that. So you're not having to go out and find another deal. Oh, I'm short, a certain amount of money. You're automatically pressing the button and starting that, which I think is really powerful. So all of those things really make a big difference inside of self-directed. Are they the only thing you should have in your self-directed? No. But notes are a great addition. So let me explain a little bit about kind of the process. I'll talk a little bit about the purchase process, and then we'll go through just a real vanilla type of process from acquisition to when you own it. So when you're buying it, first thing you need to have is, of course, you need to find a seller, right? So you need to have some access to folks that are buying and selling these. And you'll be the buyer, or your IRA would be the buyer, and it's a cash purchase. So first, you're going to locate a loan for sale, and then you'll just do an initial kind of cursory. What will happen is the seller will come to you, or you'll interface with them, and they'll say, this is what we have for sale. And usually it's short on information, so you'll have to ask them, oh, well, what about this? What about that? They'll provide all the due diligence to you, and then you'll do your due diligence. So due diligence is a whole other topic that I'd love to talk about another time, because it's very important. But you're talking about like title work, you're talking about maybe a credit report, any kind of loan documents that the borrower has signed, pay history from the servicer, all kinds of things to verify what you're buying. You want to look for problems. And every loan has some sort of problem, but most of them are small. Most of them are not life-threatening, and it's not that big of a deal. But that's the heavy lifting part, and that's where a lot of deals go bad. You'll find something you don't like. You'll pull stuff from the servicer. And the servicer really is just a third party that is your face to the borrower. So if you have a mortgage on your house, every month you probably get either an electronic or a paper statement. That's the servicer. That's not actually the company that owns the loan. There's somebody else behind that that's actually receiving the payments. That's just the servicer that's giving you end-of-year statements, interest statements, saying, hey, here's your current balance. Hey, your escrow account's short. That's all that is. So we have the same thing, and they charge a minimal amount. It's usually $15 to $30 a loan, and they manage that for you. So your IRA is buying this, and then after the fact, you're putting it with the servicer. And so the servicer is sending those statements every month to the borrower, and then the borrower is remitting their mortgage payment to the servicer, because that's all they know. They don't know you. They don't know your IRA. They're not going to call you up. The servicer is going to handle all of that. And then once a month or once every 2 weeks or whatever that remittance timeframe table is, the servicer is going to send that amount minus their $30 fee or whatever to your IRA. So it's a middleman that basically just protects you. And there's a reason for that, because obviously you don't want to be bothered to do all this accounting, and there's also statements and other legal stuff that they need to send out to essentially protect you. Right? It's not worth your time to try to do it yourself. So I got off track there, but that's a servicer. So starting again from the due diligence, everything looks great. You negotiate the price. So before you do anything else, you guys agree on a price, or a range, a tight band of price. Everything looks fine. You complete your due diligence. You complete a purchase agreement. So typically the purchase agreement is a lot like a real estate agreement. It's going to explain what your reps and warrants, or what your commitment is to each other as the buyer and seller, what's being sold, all of that. And then you're going to wire the funds to the seller. Now, you can do a couple things. If you've worked with the seller before, you can wire the funds directly to them. You do have an agreement in place, or if it's a large sum of money and you just want to be safe, you can use a third party like an escrow, which is great, easy to use. You can use an attorney. There's a number of escrow firms that do this too, and it's literally $200 or $300, so it's well worth it. And escrow, just like any other escrow, they essentially hold your funds in trust to make sure that all those documents get to you as far as the note and mortgage and that. So after that fact, you've purchased the loan. So you've executed that. You wire the funds to the seller. And then what happens is the seller will create what's an assignment and an allonge. So an assignment is assigning ownership of the mortgage or the deed of trust to you. So it's basically saying, I, seller, am selling this mortgage to the buyer. And then the allonge is doing the same thing, but for the note. And don't ask me why it's like two separate things. I mean, they should be kind of one document, I would think, but they're two separate things, so you're assigning both to you, the buyer, or your IRA. So then you have that. So you have, those are called the collateral documents. So you can either have those held in trust somewhere or shipped to your house, or you put them in your safe or whatever, but it's the original documents showing ownership. And then that, for the assignment, that's recorded at the county. So for example, if somebody was going to go try and pay off their loan or put another lien on the house, when they went and pulled title, they'd see that your IRA is the owner. So now you've got it placed with the licensed servicer. The servicer collects the payments from the borrower like we discussed, and then they take a small fee and then just deposit funds to your IRA. So you can do this individually. You can do this. I know a lot of investors who do this themselves. They want to be more hands-on and do it themselves. You can also do this. Our company does this on a much larger scale for investors. So we have a fund that does this whole process, does all the due diligence, everything, and just cuts investors a check every month to their IRA. And there's a number of other companies that do that as well. So one of the things that I do want to talk about is what happens if things go bad. And that's really always the concern. I don't want to get stuck with a property, foreclosing, all of that. And we have another fund that specializes just in non-performing assets. And so I've done a lot of foreclosure work. We've done hundreds, 400, 500, 600 loans of foreclosure work. So I'm very familiar with the process, and some of them are easy and some of them are horrible. And in general, unless you're a real hands-on person, you don't want that in your IRA. You don't want to deal with that. You probably have a number of other things on your plate professionally and otherwise. It's just not worth the hassle. So we'll talk about what happens with that, what to expect, how often it happens. Typically what will happen is you bought this loan, or our fund buys the loan, the borrower's paying, and then all of a sudden, a couple months down the road or a year down the road, they stop paying. Now, the first thing that you're going to want to do is essentially send out a demand letter. And a demand letter can come from your servicer. And the demand letter is basically just going to say that, hey, you're 90 or 120 days late, and it's time, we know that, and it's time to go ahead and pay. And usually that will fix it. There's a time frame on that where it's like 30 or 45 days, depending on the state, and they have that time to actually bring the loan current or reinstate it. After that time, if they haven't done anything, if they haven't reached out to you or anything like that, then you have some options. You have to decide, what do you want to do with that? So what I would recommend is to contact the borrower, or better yet, have your attorney or your servicer contact them. I wouldn't actually call them directly. And there's a number of collection reasons why, and a lot of states are very litigious now. So having an attorney do that is probably your best bet. It shouldn't be too expensive. But basically contact them and say, hey, we're about to foreclose. You haven't been paying for a while. Is this a short-term issue? Is somebody sick, just out of a job, you're going to get back on the horse, or is this kind of the way it's going to be? Sometimes they'll respond, sometimes they won't. If it's not resolved in a timely fashion, then you can start foreclosure proceedings to repossess the property and sell it. So that doesn't happen very often. If you've done your homework, if you've done all of the due diligence items on it, really taken your time and not rushed into anything, that's going to happen probably 3 to 5% of the time. And so, for example, if you have 100 loans, you're going to have 3 to 5 that go this route. And I don't mean that they go delinquent and then you have a demand letter. I mean where you actually have to finish the foreclosure because they're just not going to pay you again. And there's usually just a few reasons why people can't or won't pay. It's not usually they don't want to. It's death, job loss, divorce, illness, things like that, where they may not be able to. And so that's really the risk with this type of stuff. One of the things that I would say is this happens so infrequently that it's not going to be something that you're really going to have to worry about long term. It's something that usually is resolvable, and very rare cases will you lose money because the deck is really stacked in your favor as a lender. Even in the end, if you've done your homework with all of the equity in the property, all of your due diligence, even after foreclosing, you're still, in a lot of cases, most cases, going to recover your cash and or make money. Correct, yeah. And you can still lose money as well, depending on the type of asset and a number of other factors, yeah. Yeah, you're absolutely right. But what I'm getting at here is it's very rare this is the worst case scenario, right, of what could go wrong. So if you have an IRA, if this is something that you're not interested in, if it's something that maybe you're fearful of, that would be where maybe a more passive route with a company like ours or someone else who just kind of manages all this for you. You don't have to worry about it, and it's just kind of turnkey. But this would be something that an individual investor may run into. I know a lot of investors never had any issues, and they have dozens and dozens of loans. So a quick, just talking a little bit about how does note investing compare to other assets? And there's a lot of different types of assets that we can buy, and I've purchased everything from stocks to cryptocurrency to gold and silver to all kinds of things, real estate. And really what I've always been looking for is that passive kind of predictable cash flow component. And I think there obviously should be a blend of different things in an IRA. So we'll talk about bonds. Bonds really are a note, basically, right? So they're just not against property. They're against a municipality. They're a loan from a city, a municipality, a government, a state, a company. So bonds in that regard are pretty safe, depending on who's doing the loaning. They're also probably a lot less lower yield mostly. You do have things called junk bonds where you can get much higher yield, but they're also a lot more risky. Yeah. So in that sense, bonds fulfill the same thing as notes, just not quite as attractive from a payment standpoint. So the negative on those, obviously the yield is typically too low to keep pace with inflation, and that's really our goal, is to keep pace and or exceed inflation. And the tricky part about that is we're being told one thing. I think we just had a report of 4%. We know that everything that we're buying is gone up more than 4%, so obviously that's not true. So it's kind of subjective at this point what inflation is. We all have a different opinion of what that is, but whatever that number is for you in your head, our goal is obviously to be earning more than that, or at least that, so we're not having a depletion of our cash. Real estate is another thing. Real estate goes very well in a self-directed IRA. Real estate does have appreciation if it's held long enough or in the right area, growth, tax savings. It does have cash flow if it's structured correctly. The negative to it is it does have carrying costs depending on how it's structured. You do have tenants, toilets, insurance, all of those other issues. So it's less of a passive type of investment, whereas notes are pretty passive once it's set up and done. You don't have to worry about the rest of that stuff. You're never going to have a borrower calling you. Real estate, depending on what kind, does have multiple moving parts. The buying mortgages is pretty simple once you get past the due diligence stage. So after that, it's not rocket science. You don't need to know a whole lot. You just need to understand the basic mechanics, and then after that, you're just monitoring your portfolio and making sure that the checks are being deposited from the servicer to your IRA. Other things, stocks, cryptocurrency. Cryptocurrency obviously is very volatile right now. We have things where even just the legality of it is being challenged and all kinds of things, so that's a very speculative type of investment. Stocks, more stable. The rules have at least been designed long enough that everybody knows what's going on. But you do have ways to make money, but it's also really a speculating type of thing. Unless you're a full-time trader, it's very, I have relatives who had a large amount of money in stocks a couple of years ago, and there was a news announcement or just something totally random, and they lost $300,000. Just no control, just gone. And they had worked at a hospital for however many years to earn that, right? It's just gone, vaporized. So that doesn't happen with notes because you have something that's there, that's tangible. Stocks, obviously, we just talked about that, very speculative, not a passive investment. Obviously, there is money to be made there, but that's not something that you really want to feather a lot of money into in an IRA just because of the uncertainty. With these types of things, we have to buy low and sell high. One of the concerns that I have later on is, let's say you're buying for the long haul, right? You're investing in that. And as you get nearer to retirement, the only way you're going to be able to access those is if you sell them. How do you know they're going to be up that year when you need to sell them? You don't need to worry about that with notes. It's kind of steady Eddie all the way through. So I'll wrap this up before we get to the questions and answers, but I'll tell you a little bit about what we do. And this may or may not be a fit for what you're doing. You can obviously purchase loans on your own. That's totally doable. If you put the effort and time in, you can do that for your own IRA. You can buy them at a discount. There's a whole bunch of advantages there. For what we do is our company, we cater to investors who are older, like myself. I was called old. I was talking to somebody, and they're like, oh, yeah, these older people are like 40s and 50s. And I'm like, I'm 46 this year. What are you talking about? I don't feel old. Your mind never feels old, right? It's just the body. I still feel like I'm 10 years old. But what we do is we cater to investors who are usually business professionals, right? They have something else going on in their life. They're making money. They're planning their future. And they are educated. They want to know what's going on. They want to understand what the investments are, right? But they also want to be largely hands-off. So that's what this is based around. And we do have investors that do a little bit of both. So they'll have some passive stuff, and then they'll go out and buy some loans on their own. So with this, what we do is we have what's called an income fund, and it aggregates capital from investors. So I'm invested in it as an investor, and it goes out and purchases performing loans, mortgage loans, all over the US. And it's not all in one spot. It's geographically diversified. And so what that means is it's looking at properties that have a fair market value of $200,000 and higher, right? So you're not looking at $40,000 Ohio properties. You're looking at higher value, higher income people that can pay. And you're going through all that due diligence stuff that we talked about, right? Vetting out the stuff that's no good. And then you're buying these at a discount and putting them in the portfolio with the servicer and monitoring them and just leaving them. So you're not doing any flipping. You're not doing any foreclosure work. You're not doing any of that. If something were to go bad, where, like we talked about, where you send them the demand letter, they stop paying, all of that, and you actually have to foreclose, that bad loan is removed from the portfolio. It's sold off to another party, so it doesn't yield drag anything in here for our investors. So there's never anything in here that's like being foreclosed or dragging it down. The yields on it are 8.5% to 19%. So 19% is after a handful of years with compounding. So it starts at 8.5%. If you do the 4 times per year compounding, you're closer to 9 something, automatically. You're able to exit and enter anytime you want. So for the first, I'll take that back. So the first 12 months, what we ask investors is to essentially commit to 12 months. Anytime after that, you're free to come and go. So you don't need a reason. You just raise your hand and say, hey, I want some of my money back, all of it, whatever. Different investment, you can do that. You can also contribute any amount at any time. So smaller amounts too. It doesn't have to be a huge amount of money. And then the fund has a third-party CPA that does all the bookkeeping. My partner is also a certified CPA who does a secondary check on it. And then all of those get distributed deposits to your IRA each month. So so if you think about it, have a large portfolio of performing loans. Those loans are paying the servicer every month, just like you'd pay your mortgage. Servicer is paying the fund, and then the fund's doing the accounting and distributing to your IRA. So you can compound your earnings 4 times a year. It's just as simple as letting us know. It doesn't cost you anything. What that means is every quarter, instead of getting monthly deposits, the fund would retain those per your direction. And then 4 times a year, they'd be compounded. And so you'd see that in your account. You have a portal where you can log in and take a look. It shows you, so you know what you're being paid, et cetera. A lot of investors, what they do is they'll invest and then see the first few deposits, right, before they do any compounding, so they actually see that their IRA is getting the money, and then later on they could do compounding. And then there's also an upside where investors who have a total amount, and it can be from different accounts, of $250,000 or more, they participate in early payoffs. So an early payoff is, like we talked about, I didn't get into this too much, but essentially the discount when you're buying a loan. So a discount would be on the secondary market. Let's say the borrower owes $100,000, and we might buy that for $75,000. So you have a $25,000 delta there. And occasionally what will happen is we'll buy the loan, put it in the portfolio, and 4 months later it'll pay off. Well, it's close to a full payoff. The borrower might refinance or sell or whatever. Happens randomly. Well, there's $25,000 extra there, and typically that goes to management. With investors who have invested $250,000 or higher, they actually participate in that as well. So they get all their compounding, the 8.5 plus a percentage of that payoff. So it's random. Some months we have none, and then other months we'll have 5. And what that ends up doing, looking back historically, is that will boost investors without compounding at all up to probably about 10.5 or 11.5 annually. So that's really what we cater to with our offering. And then one of the last things I would say is the advantage to investors with this is it's turnkey. You have oversight, so you're able to see things, what's going on. We have geographic diversification, so we're not all in one area. It's spread out nationwide. And then we have, of course, quarterly updates. So every quarter, we have a webinar that's about an hour long or so that's recorded, that we go over the financials. You get access to everything so you understand, the financial state of what's owned by the fund, all of that. So you're kept in the loop the whole time. All right. And then, like I said, if you haven't had a chance to pick up a copy of my book, I'd appreciate it. We'll ship a copy to you. I was going to bring a bunch here, but I can never tell how many people are going to be at an event. So sometimes one time I came with like 50 books, and there were 4 people. And then other times I bring none, and there's everybody. So the easiest way is on the website, and we're happy to ship it to you. And then you can also schedule a call if you have a question. I think I have one more slide.
No, I have a
And there it is. So, yeah. And so that's my presentation for tonight. And I know I did a lot of rambling tonight, but I was hoping to talk to you guys and hear any questions that you might have as well, because I want to make sure that I'm adding value to have you guys come out tonight.
Yeah, absolutely. I will go ahead and pass the mic around so that the people online can hear the questions as well.
So how long have you had this fund? How long have you been in business? And do you have to be accredited or non-accredited?
That's a good question. So you do need to be accredited. Yeah.
We have family member that we're trying to get into deals like this. It's so frustrating when they're not accredited.
And it's not that we don't want them. It's more or less the type of filing, the registration that we have kind of, pigeonholes us into that. Otherwise, we're not able to tell people unless we have this long dating relationship. I wouldn't be able to talk about this with you tonight. So yeah, it does need to be accredited.
Okay.
Yeah.
And so how long have you been doing this? And when you do have a non-performing note and you take it out, do you normally make money with it, or have you lost money in the past with that?
Yeah, so we've definitely lost money. It's rare, and it's not catastrophic. So to answer your first question, this fund is fairly new, the income fund. This is a little over 2 years old. We have a previous fund that is a couple years older than that was specifically targeted to non-performing notes, and that one's being wound up. And then I had another fund, I would say 3 or 4 years before that, which is fully wound up, meaning it went through its life cycle. We paid off all investors. They got their profits and then returned their original capital back.
So what is the typical length then of one of these deals if you buy it from the beginning and stick to it till the end?
So if you were going to buy a loan or invest in the fund, you mean?
And you said invest in the fund, but you said you had so far you've done 3 funds.
Yep.
And the first one has already reached its cycle.
Yep.
So what was that cycle from beginning to end?
Yeah, so that cycle, essentially, it depends how you structure it, but those 2 funds had an end date, right? So the first one had an end date, had a 5-year term. So at the end of 5 years, everybody had already pre-agreed that we're going to roll this thing up and it's going to end. The second fund was an evergreen, but it was very specific. Evergreen meaning it was going to last forever until we decided to shut it down. There was no targeted end date, but investors could come and go as they wanted. And that one rolled up because the market had changed for that type of asset. So we decided it's best to kind of just roll it up and pay all the investors back their original principal. Yeah.
Josh, you mentioned 8.5 to 19%. Is that just a reflection of the typical performance that you've had track record-wise, or is that contractually bound to be 8.5 to 19%, depending on the nature of it?
Yeah. So the 8.5 is when we purchase a loan, it's run through basically a funnel, every loan, and it has to meet at least 8.5% plus some for expenses like servicing fees, and then something small amount left over for management. So it has to meet that prior to purchase. Every loan that comes in is profitable from day one. For investors, the 8.5 is what's called a preferred return. So that's going to be any profit that hits the books, the first 8.5 goes to the investors. So if there's nothing left over, management makes 0. That's never happened yet, but if that were the case, that's what happens. Up to 19 is with, I can send you more information, but it's with compounding and it's giving a little bit of time. So it's a 2, 3 years, something like that. So if you were using compounding the 4 times a year, and I want to say, I'll have to look, but I want to say it was with the profit sharing as well. So it's not instant, right? So it wouldn't be 19% right from the gate, but it would work up to that and keep going.
What's the IRR on that?
I don't know.
I kind of.
Sorry, my question was what's the IRR on that? Because realistically, if it's on the compounding, that means that your IRR is still within that 8.5 to 10%. But the 19% really assumes that it's on your original money, but actually you're contributing more, so it's kind of weird.
Yeah, I don't know. That's a good question. I don't know what the IRR is. With mortgages, we've typically just used yield. So that's really how we price things, the time value of money with yield. But that would be an interesting exercise to see what the IRR is.
I have a question
Yeah.
that's now a little bit more
Sure.
related to the notes themselves.
Yeah.
Can you speak in a little bit more concrete numbers? What might an investment in a note look like? Meaning, what is the minimum or like what is the price of notes you would usually find?
Yeah.
What will be the interest rates, or like basically what will be your return based on that note? And in a way, what kind of discounts you might get, and why would somebody actually sell it to you at a discount?
Sure. I'll try to answer all of that without saying it depends.
I understand.
Yeah.
It's just in general.
Sure, yeah. So in general, starting with the easiest one first, the reason why someone might sell that is they need money. Or a lot of these sellers could be banks, credit unions, private individuals, large money people that have huge portfolios of these, and they essentially buy 500 at a time, and they have a certain buy bucket, which is like, we want these 150, but we're buying the whole batch, and then they parcel off all the other ones they don't want. And as long as they're not losing money or they're making some money, they don't care. So there's a lot of reasons why somebody might do that. Your other question as far as like what's a typical deal look like? So it's really going to depend on how much money you're interested in investing or buying one. So I started fairly small, but $19,000 is still $19,000, right? It's not no money. And it comes down to what kind of monthly payment in your IRA do you want to see that makes you feel like you're winning? So the smaller loan you buy, you can buy loans for $4,000, $5,000, but you're going to get a $45 a month payment, right? Because the loan's just not big enough. So you kind of want to decide, where am I comfortable entering, dipping my toe in? And for a lot of people, maybe that's a few $100 a month, right, to see it. So I think my first one was $350 or $400 a month is what my IRA was getting. So you can spend anywhere from 10 grand all the way up to the sky's the limit, right? As far as the rate's going to be all over the map. So the rate could be 3% all the way up to 9 or 10 or 11%, 12%. And the higher the rate, which is what the borrower is paying, which is all they know, the more you can pay for the loan. Because let's say, for example, you need to make 10%. Like, this is kind of where I need to be, my happy place. My IRA needs to be making 10% a year yield. Well, if the borrower is already paying 8 or 9, you can almost pay full price for that loan, full unpaid balance. So there won't need to be a discount. Like in that example where there's 100 grand, you don't need to buy it for 75. You could buy it for like 95. So that rate depends on how big of a discount you're going to get. So the discount isn't really important. It is, but it's not what you should focus on. Your yield as the investor, what your IRA is taking home is what matters, right? So the big discount helps if you buy it and 6 months later the borrower pays off, because then that's great. You just got a windfall. But you don't know if that's ever going to happen. So the yield is really what you should focus on, or IRR if you're more comfortable with that calculation. The higher the better, and see where that kind of jives with the yield. So you could start with 10 grand, 15, 50, and do that. And then there was one other part to your question that I have spaced at this point.
I think that covered a lot of it.
Okay.
I think, yeah.
Okay. Yeah.
Before we get to the online questions, I believe you had a question.
Yes, how long is your expectation? Excuse me. How long is your expectation that this fund will last? 10 years?
It should be around for a while. Yes, I would say at least 10 years. That's our plan. Yeah, and one of the reasons for that is it's very stable. I mean, it's almost boring. There's not a lot of moving parts to it. We're not flipping. We're not needing a whole flood of deal flow. It's just you're buying loans and setting them there, and they're producing income on their own.
And what would be an indicator that you would be closing the fund?
We would tell you.
Why would you close the fund?
If there was a situation where something unforeseen, where it's no longer profitable, where I can't think of a reason, but if there was, let's say, like a regulatory issue or something where we as managers are able to see that there is increased risk to investor capital, or they may not be paid on a regular basis what the minimum pref is, the 8.5%, then that would be something where we would consider rolling the fund up, which is essentially where you're returning investor capital, their original contribution. So they've collected, interest and income that whole time, and then you're saying we're rolling the fund up, now we're returning your contribution. Yeah. It's unlikely to happen in the near future. We're working hard to have this go very long term. Yeah.
Okay, we do have a couple of questions online. One of them says, is it a requirement to have an IRA before starting purchasing notes?
No, not at all. I mean, you should. You should think about it in your IRA with Quest. Like I'd mentioned, we've worked with a lot of other IRA companies, and Quest has been like the most supportive, the best feedback from investors that use them. I mean, I have a lot of personal friends that use Quest. And I'm not making that up. That's the absolute truth. They're very, very easy to work with and very responsive. So you don't have to have an IRA to do it. You can do it with cash. I know a lot of investors who do a little bit of both, right? So they'll have some free money in IRA, and they'll invest with that, and then they'll have cash or otherwise in something else, or maybe a business LLC, and invest out of that. So it's just a cash business. So as long as there's cash available and it's legal, you can invest.
I love that answer, and yeah, it's a great choice to be diversified. Make money today and make money for the future.
Oh, there is one tail end to that too. So there's no UBIT with this kind of thing. So you don't have to worry about that when it's in your IRA. So it does work well if you're considering like other types of investments that might generate UBIT. This does not.
Awesome. Do I have to go to the secondary market to sell the loan?
Well, the secondary market's basically just investors like us. So it's just a fancy word for non-bank type of entities. So you would have to find someone to buy the loan, yes. But if it's a clean loan and a good deal, you're asking the right price, that's not hard. I mean, if you have a loan, I could help you find someone.
You hear that? Alrighty.
Yeah.
And then the last question from online was, how do the early payoffs work?
So the early payoffs, essentially, going back to our example, investors are qualified at $250,000. So if they have an aggregate, it could be multiple accounts, but if it's $250,000 or close to that, they can participate in early payoffs. And early payoffs, essentially, we buy most of our loans at a discount. And so there's a spread there, and we do get payoffs. And so what happens is at the end of every month, we calculate if there's payoffs and how many. And then 50% of that payoff amount, that profit, is split with qualified investors. And how that works is the pool is constantly moved forward. So in other words, the other half is split with management. And it doesn't matter, this is more of my CPA partner question on the math, but it doesn't matter how many investors are qualified. The pool keeps expanding. So in other words, you don't get shorted if more qualified investors come in. You're not getting paid less, if that makes any sense. Yeah.
I forgot my question. Yes, I remember. So is there like a marketplace you would recommend that we can go and browse for notes and see at least what's out there? Because now I'm curious, but I want to just go and browse what's out there.
Yeah, so there used to be a couple really good ones, like FCI, which is a servicer that we used to have what's called FCI Exchange. No longer exists. That was my favorite. It was several years ago. There's one called PaperStack. I think it's STAC, PaperStack. There's a few other ones that I haven't used, so I can't really recommend. There are some good broker lists. So there's a gentleman, I don't know his email, but if you give me your information, I can get you his info. His name is David Polio, and he has just kind of a general catch-all list, and he'll blast you with all kinds of offers from basically sellers. like us, like you, like just regular investors who, hey, I've got one note, hey, I've got 50, and a lot of them are junk, but it just gives you something to look at, and you can kick the tires and talk to them and hassle them, and it give you like experience, right? Learning.
What was the name?
His name is David Polio, and I don't have his contact info with me, but I can get it to you. Yeah. You could also just message me, just email us on the site and say, hey, send me his information, and I'll send it to you.
I believe you might have mentioned this already, but we had a couple of people asking again online. As an individual investor, is the money pooled or buying individual notes?
So in our fund, or just as an individual? Oh, in the pool. So it is pooled. Yeah. So it's a pooled fund. Basically, we have a Reg D fund, and so we go through all the the federal regulations involved in doing that. And what you're buying, essentially, you've got an LLC that has all of the entity. Then you have a bank account that's dedicated for that LLC. You have a servicing for that LLC, and investors are buying shares of that fund. So you're buying ownership. You're buying legitimate ownership of this fund that's generating money. And so as an investor, the advantage is it's not like you're buying a loan and you're hoping that loan keeps paying. You have ownership of that entity that owns all of these loans. So you have a fractionalized ownership of everything that the fund owns. So, and the shares are fixed, so it's not like they go up and down in price. It's just a fixed.
Yeah, my question was more around risk and understanding it. What you were talking about with the woman before's question on the fund, and you were talking about the average person's buying a note. The fund appears to be buying notes minimum $200K in value, but trying to get an 8.5% yield or more. Is that correct?
So we do have the 8.5% minimum hurdle, yeah, for us to buy, but we buy loans at a much lower price. So the $250,000 was like the minimum investment for an investor to qualify for the profit sharing.
Okay,
So
I
on
thought it was
early
like a guarantee.
payoffs.
Okay.
Yeah, you don't have to do that.
Got it.
Um,
Is the fund, how many notes does the fund hold per average, and what's
So I
the
think we have-
LTV of notes, and are you doing first and second? So
We have a combination, yeah. So we have first and second liens. I want to say we're close to, I should have brought this with me, but I want to say we're close to 100 loans now, right? And then we're going to keep scaling up. We're continuing to grow. And so the purchase price on that, so what the fund is buying those for, they're not all at $200,000, investment cost. It's
the value of the note is $200,000, which you may pay less for.
So the value could be anywhere from, $75,000 if it's a second lien, all the way up to $700,000 if it's a senior lien, right? So it could be all over the map as far as what the value is of the note, the unpaid balance that the borrower owes, right? And then we're buying it at a discount, so whatever difference there is. One of the key things for us is we don't want to be overly concentrated in just a handful of loans. So like big loans that have a large percentage of the fund capital in these 4 or 5 loans. And if those go bad, something's wrong, right? So we prefer to be diversified into maybe some smaller purchases to where if there are issues, we can deal with those and it doesn't affect any kind of income for investors, if that makes sense.
And after the investors have been in it for a year, they're able to pull money out. How do you prevent something from happening like some of the banks if too many people wanted too much money out at once?
Yeah.
I'm curious how that works
Yeah.
with a fund like this.
Yep. So the way this fund is, it's passive for investors, and so all of the day-to-day is for management, right? It is management's discretion. So if for some reason we had everybody say we need our money back today, well, the first issue is there are reserves, right, in any business, but most of the money is in the loans because we're using that money to purchase an asset to produce yield for investors. So what would happen is if we had, let's call it an investor run, we would say, look, here's where you're at on the investment timeline, right? So it's a first in, first out, meaning if you were one of the earlier investors, you have the chance to be redeemed sooner, right? And then we say, okay, we send you a redemption form, and then we would make sure that we have sufficient capital to redeem that investor and or sell performing loans on the secondary market to free that cash up.
Right. And you might, if you have 10% of your investors, you don't have to sell 10% of the loans.
Yeah.
Others would still be performing.
Correct. Everybody else is totally oblivious to it because it doesn't affect them. Yeah. Yep. And if everybody, like this is, I don't know how this would be possible, but if everybody wanted their money back today, that would be where it has to come that order of first in, first out, right? Because you wouldn't just fire sale everything because that may hurt other investors who are currently in who don't want out, right? So you'd have to kind of stage it. But ordinarily, just for an average investor, it's not an issue. Yeah.
That's when you close the fund. So the
Right.
question is like, when does the
Right.
fund
What's the highest LTV you go to?
So I think we've had, I want to say we were at like 76, something like that. And then we have some that are really low. So it's yeah. But I could get you more data on that if you want a closer look.
Let me ask him a quick question. Going back to the original question, the one before, Mike, how often do people pull their money out?
The question is, how often do people pull their money out?
Yep. So that's a key metric that we look at because obviously the more people that are leaving are less happy, right? So I just talked to my partner a day or two ago, and I think this entire year we had one person leave, so year to date. And the reason for that was it just wasn't a good fit from the beginning. So they had expected something that really wasn't going to materialize as far as either yield or maybe there was miscommunication. I don't know what it was, but it just wasn't a good fit. And so we said, we're going to go ahead and redeem you. But ordinarily, our target investor that we best serve is someone who has a type of self-directed IRA where they're not frequently moving in and out, right? They have the option to do that, but they're not using it like a bank account in and out all the time. So it makes it easier and a lot more stable too.
So you said that we're essentially limited partners in this fund, correct?
Yes.
Okay, so in that sense, it's equity, but it's passive income. So when we get our K1, is it going to be all passive income, and will our passive loss carryover from previous years reduce that, or is it going to come in as ordinary income or non-passive income? Do you know the answer on that one?
Part of it. So I'm not a CPA. The answer, as I understand it, is you're going to have, when you get a K1, which you will, you're going to have two parts. So you're going to have the interest income, right? And if there was a loss, we haven't had a loss yet that flowed down to investors, but if there was, you participate in that. You would have interest income on the K1, and if you participated in the early payoffs, you'd have discount income. So it'd be a smaller percentage of that actual amount, and that would be taxed differently, yeah, based on capital gains, like how long that was held and so forth.
So outside of the Paper Profits book that you wrote, do you have a recommendation for other good books on notes investing?
That's a good one. I have two colleagues who wrote books, and I cannot think of the names of the books right now, but I'd be happy to get those to you. Yeah, if you want to leave your information, I'd be happy to get those to you. They're both very trustworthy people, and they know what they're doing. So yeah, there's a couple other books out there that I could recommend. Yeah. Yeah.
Did you have a question? Yeah, you can go.
Yes, approximately how many investors are there at this time?
I think we have,
Approximately how many investors this time, I believe?
yeah, I want to say we probably have about, I think we have about 75 or 80, yeah, in this particular fund.
Do you have a feel for how many are up to the 250 mark participating in the early payoff?
I don't. I need to get those metrics, but I can get them for you. Yeah, yeah. And I know our average investment is around 75,000. Yeah. So that's overall investors, just the average, yeah.
What's the minimum?
The minimum is 50. So we do make an exception. I know that we have had some investors where, you know, you have multiple investments going in and out of your IRA, and you have 47,000 or whatever. We'll make an exception for that if it's close. Yeah.
Is it you and your partner, or do you have other employees?
We do have employees. Yeah, we have 3 employees. Yep.
So can you put yourself in the investor's shoes as a accredited investor going to do their due diligence on your company? What would you suggest that they look for?
That is an excellent question. I think the risk management and your risk management question too, because I'm always looking for where could it go wrong. What I would do is I would ask, obviously for references, right? I would ask to talk to somebody who's in it now, who's totally unrelated to me, who's happy, who's been there for a while, or maybe not happy, doesn't matter. I would ask for some historicals, right, of maybe the last 2 funds that I mentioned. Like, can you show me, you know, proof that those existed, the financials? You know, I wouldn't be able to share investor names and personal information with this person, but I think that would get a start to, you know, something like that. I've had people ask for a background check, things like that, which, you know, if it's done in good faith, I'm happy to do. So those would be places that I would start. Yeah.
Okay, next question.
So you collect capital from us, and do you do anything like taking it and getting a line of credit
No.
and leveraging it?
No, there's no leverage whatsoever. There's no loans, there's no leverage. It's a cash business. So all of the cash is used to buy loans, period. So the only, yeah, there's no banks, there's no lending.
I want to say correct answer.
Okay. Well, I'll tell you what scares me is leverage. And I know there's a lot of benefit to that in different things, but you can get really, really hurt with leverage. And I would rather have a little bit more boring and maybe not as big and feel good about it, right? Because I have family, I have relatives that are invested with us, and I have my own money. And so it's one of those things where it's not worth it to me. Because if we're buying right and we're using cash and we're being prudent with it, you don't need to use leverage for it.
Really correct answer.
Thank you.
Okay, and with that being said, we'll go ahead and wrap it up. Let's give Josh a big round of applause.
All right, yay! Thank you for having me tonight.
Yes,
Thank you for coming out. Yeah.
And if
Everybody
y'all
watching?
do want to reach him, contact information is here, so do be sure to do that. Yeah.
Take me up on the book as well. We'll ship it to you. So if you want it. Yep.
Okay, one more round of applause. Okay, and I'll quickly run through some of these announcement slides because I want to give you guys the chance to still network a little bit. But if you want to get more information about Quest or setting up a self-directed IRA, do be sure to scan this QR code and schedule your free consultation. It'll get you with an IRA specialist. And if you do choose to open up your IRA and move over some funds, we will actually reward your account. And the reward will be dependent on how much you move over. So we're calling this our reward for deposits. And then additional educational resources in the way of blogs, classes, videos, our National Networking Happy Hour, and our new Power Play Tuesday. You can find them all right here. And if you do ever miss a class, you can go to our YouTube page and catch it there. And here's our next big event that we have coming up. It is the Luau Link Up! Woo! So next month, Questy will be joining us, and we are going to be themed event here in the office. We're going to be doing guided networking. So if you have a deal, or if you're looking for an investment, you'll get a color-coded lay, and it'll have a certain meaning for what it is, for what you are as well. So, You are not required to dress like Questy, but you will get a prize if you come in the best dressed outfit. We'll have themed food. Yeah, so if you want to beat her, you got to come and you got to dress to the occasion. But you can get registered over here. It is free. We would love to see you, and we'd love to get you signed up tonight if we can. And then last, we have the Multifamily Summit. If you'd like to travel up to Dallas to learn a little bit more about multifamily, you can do that on August 12th. We'll be having a full training day up there. Right now, tickets are only $50, and early bird will be going up. And with that being said, there we go. Thank y'all so much for coming. Feel free to go get signed up over there and continue networking with our last little bit of time.